Welcome back. We are seeing, let's pull up SGX Nifty. For the moment, that's creating a bit of a jitter. It's a little better than what it was when we last checked. We were down two-thirds of a percentage point, maybe 50 points down. Now we are about 41 down, but good to keep the global backdrop. It's at the moment a little under the weather. But plenty of stocks to speak about. Gautam Duggad, the head of research institutional equities at Motilal Oswal Securities, joins us now. Gautam, good morning. Thank you very much for joining. What might give leadership here on? Is Motilal Oswal buying at all? And in the Nifty, where can leadership come from?
Good morning. So if you see the markets today and if you analyze the context of this market over the last 2 years, the markets have virtually been on treadmill, I would say. It has taken all the running to stay where it has been for last 2 years. We were at 9,000 2 years back. Today we are back to 9,000. What has changed meaningfully in this circular journey is the backdrop of valuations. So today when we look at valuations, whether it is trailing or forward, we are at around 28.5, 22.5 on a trailing basis and somewhere close to 18.1, 18.2 on a forward basis. So clearly the valuation backdrop is not as benign as it was, say, 6 months back post demonetization. Today, what is more important is the recovery of earnings. The last 4 years, the Nifty EPS has virtually stayed flattish around 400 rupees, give or take 5-10 rupees here or there. Today, the estimates that are being there is building in almost a earnings growth of 18 to 20% for FY18 and subsequently around 20%. So we are virtually talking about a 20-21% earnings CAGR for next 2 years. This has been an elusive earnings growth for last 4 years, be it Sensex or Nifty. So that is one important point that we need to take cognizance of. Now, in terms of what can take the leadership, we have seen in the last 3-4 months, each stock has basically seen leadership for last 3-4 months. It has been Reliance, it has been L&T, it has been private banks. So I think the market is clearly polarized. There are sections of stocks which have been running and there is a section which has been virtually doing nothing. So if you split the market sectors itself out of the 14-15 sectors that we have, barring pharma, IT and to some extent telecom, rest of the sectors have taken turns to provide the leadership. Going forward, as far as our estimates are concerned, we are building in close to 20% earnings CAGR. Some of the sectors where we are seeing very strong recovery panning out, and this is the hope as of now, is autos, I think private banks, in fact PSU banks also, but that is more a case of base effect, and then cement and some sections of the consumer stocks. So I think that the entry level valuations today at around 18.5 times with an underlying assumption of a 20% earnings growth, and if that were not to pan out, let's say if 20% becomes 10%, you are virtually talking about a forward PE of 20. So clearly returns from here on is not going to be an easy journey. One has to be very stock specific, very cautious, even as the underlying liquidity both from FI as well as DIs remains very strong. In fact, for the month of March, we have seen almost $4.6–4.7 billion of FI flows, which I think is the highest monthly flow in almost 5 years. So liquidity backdrop is strong, macro backdrop is, it could not have been more stronger, and post the state election victories, there is an expectation of the earnings of the reforms momentum continuing. But what has been elusive so far is the micro side of the equation, which is the earnings growth. If that were to pan out, then clearly there are more legs to upside. Otherwise, I think from a 12 months point of view, we do not see much upside from where we stand today.
Gautam, good morning. So this 20%, 21% earnings growth that you expect, what do you think would lead it? Would it be led by banks, Reliance, ITC? I mean, which would be the sector leaders or market leaders from here?
So if I look at the earnings breadth of the, or rather the expectation for our universe, or for that matter even the Nifty or Sensex universe, we think around 3 or 4 sectors could drive this earnings. One is autos, one is clearly banks, both private as well as PSU banks, and third is cement. And at the margin, we also have very strong earnings coming in from the metal side. Metals has been completely depressed for FY16. FY17, metals has been one of the best performing sectors, and we have seen strong earnings growth happening over there in the third quarter of FY17. Our expectations for fourth quarter are also equally good. So I think these are the 4 sectors where we are going to see strong earnings recovery, or this is the expectation that we have today. Whereas IT, whereas consumer, pharma, utilities, they will be slightly muted in that sense. So banks, auto, cement and metals are the four sectors where we see strong earnings recovery panning out. And as we speak, we are almost in the midst of the fourth quarter preview. So I think that fourth quarter itself, from an earnings point of view, you will see a repeat of what has happened in the third quarter. 3-4 sectors driving the entire delta. As far as our universe is concerned, we think that PSU banks, metals, and to an extent oil and gas, these three sectors are driving virtually the 100% of earnings delta that we're going to see in fourth quarter, which is actually the case even for third quarter.
Sure. Gautam, what about capital goods? Because I see in your note that one of your top ideas has been L&T for a while. Do you see any kind of capex recovery coming through, and would capital goods also be added to that list of top sectors?
See, capital goods, one has to take a very stock-specific approach. There are a lot of companies which represent diverse subsectors of the capital goods paradigm. Now, capital goods, if you look at the capital spending, underlying capital spending, there are two parts to it. Public spending has been quite good, but some of private capex recovery has not happened. Now, within that, L&T, clearly we have seen some rally in the stock in the last couple of days. But as far as the earnings cycle is we do not see any meaningful private capex recovery panning out, at least for the next 12-18 months, given where the capacity utilizations currently lie and given the over-leveraged balance sheets that most of these infrastructure guys have. Now, obviously, within the whole spectrum of the capex sectors, you might see some bit of buoyancy in roads, some bit of buoyancy in railways, irrigation, some of those sectors. But broader capex recovery is yet to pan out. So I will refrain from saying that capital goods is going to show any meaningful buoyancy. As far as earnings growth is concerned, stock market or price returns can be anywhere. But the underlying fundamentals, the underlying earnings growth does not inspire too much confidence as of now.
Okay, we have a couple more sectors to discuss with you, Gautam. Please do stay on. We have to invite Hemant Thakral, the National Head Derivatives Desk at Aditya Birla Money, into this conversation. Good morning, Hemant. Thanks for joining. What's the Nifty trade today? Is there a short trade?
See, Lata, good morning. Lata, the way I see it, the Nifty, the data points that we track, still pointing out to all positives right now in the market. So we are tracking very carefully how the put writers are moving their positions. Till now, we have not seen any violation of any put writing level. From 9,000 to 91 to 9,200. FIs have been buying index futures, and in cash buying has been continue. Volatility, India VIX has been under very controlled levels. So nothing, in fact, in the front of an event also I was watching yesterday, VIX did not move up. So these all are signals of the market which are telling that market is still in very strong hands. And what we feel is that correction days like this should be only utilized to enter long positions. So we continue to be a buyer on the any dips. 9150 should be the stop loss, and we feel that 9350 should be achieved as a immediate target in coming, say, 3 to 4 trading sessions. Yes, if 9150 is violated, that means first put writer positions are challenged, then we will close these long positions. But till that time, it remains a buy on dips from our side.
Okay. Well, Hemant, stay on. Gautam, I wanted to ask you about, the mid caps, auto ancillaries in particular. Any names that you favor now that Europe is reflating and some of the Indian stocks are, automobile companies are doing very well?
Sure. So auto anchs, while we do not have too much of coverage on auto anchs, one of the name which we like within the auto anch space is Endurance, which has a pretty steady earnings profile. We in fact recently started coverage on it. It's a recent listing. It seems to have done well. But within the broader mid caps, as you referred to, I think what one needs to be very cognizant of is the earnings growth and also the valuation premium, which seems to have expanded month on month for last 3 consecutive months. So if you see today, compare the valuation of mid caps versus the large caps, the valuation premium of a mid cap is almost 19-20%. And this used to be some 10% 2 months back. So clearly the mid-cap valuations have inflated at a much faster pace in the last 2-3 months. And that in a way seems to be a function of the liquidity flow that we have seen. DIS flow in the last 2 years has been virtually almost $16-17 billion. So that clearly has driven the rally in the mid-caps that we have seen. So I would be very cautious on mid-caps from where we are today. I think almost 20% valuation premium. There's very little precedence in the past where this kind of valuations have valuation premium rather has sustained for far too long. There are obviously in mid caps always bottoms of stories where one needs to do a lot more work, but as a broader space within the mid caps, one has to be very cautious from a valuation perspective.
Okay, Gautam, just looking at your top ideas, what's interesting is in the banks you have ICICI and State Bank of India and also RBL Bank. Not the usual suspects that we see, the Yes Banks, the IndusInd Banks and the HDFC Banks of the world, or even Kotak. What explains this call?
So there are two ways to look at the banks today. One is the expectations of a recovery in the stressed asset cycle. There is a lot of expectations which have been building up for the last 2-3 weeks. So within the overall corporate side of the banks, we prefer ICICI and SBI. Clearly the interest rates have been quite benign for them so far. And obviously if there is a recovery out there, plus the fact remains that they are sitting on a very low base of earnings. So ICICI Bank for that matter, if you look at the last 4-5 quarters, the earnings base has been virtually depressed. Now that is going to see a revival. That is what our expectations are both for this quarter as well as for the next 2 years. As far as private banks are concerned, what drives our preference for RBL is the fact that the growth and the visibility of growth for multiple years, which is very strong out there. If you look at HDFC Bank, IndusInd, Kotak, they've been growing at 25-27% for Kotak and IndusInd, as well as ICICI Bank. HDFC Bank has been somewhere around 15 to 20%. Now, from a meaningful delta perspective, we think the delta in some of the mid-sized private sector banks, new generation private sector banks, is much higher. In fact, our expectations for the earnings CAGR for RBL itself is 40% for next 3 to 4 years. They've done around 60% earnings growth CAGR for last 4-5 years. So I think the visibility of earnings and the longevity of that earnings drives our preference for some of these names.
Okay, Gautam, we have to take a break at the moment, but I just request you to stay for a couple of minutes more. We'll take a short break and come back with the pre-opening levels and chat with you some more. Hi, welcome back. We have been in conversation with Gautam Duggad of Motilal Oswal Securities, and a couple of more seconds before pre-opening kicks in. Gautam, before we end the conversation, I noticed that in your list of consumption stocks, you've liked stocks like Colgate, Britannia, etc. But some of these names like Britannia have been in a bit of a funk for the last 6-8 months or so. You see a fresh bout of energy in these consumption stocks?
See, as far as the ideas in the consumption space is concerned, the preference is driven more from a 3 to 4 year kind of a structural view out there. Coming back to Britannia, what they've done exceedingly well is the way they've expanded their distribution franchise. And despite demand, their volume growth has not come off. The underperformance of the stock for the last 2 years is largely driven by the expensive valuations which it was sitting on a couple of months back, or rather a year back. But the fact remains that the volume growth has not come off, despite the overall consumption growth coming off for virtually the entire FMCG pack. That is point number one. And point number two, as far as Britannia is concerned, we have seen hardening of commodity costs in the last 5-6 months. So while they do have the pricing power, but the mismatch of pricing and the commodity inflation sometimes eats away the margins, which has been virtually the case for the last 2-3 quarters. But as a franchise, we continue to like Britannia. And as far as Colgate is concerned, the fact remains that they've been able to handle this whole onslaught of Patanjali in a much more resilient fashion. In fact, the market share drop that we had seen 4-5 quarters back, that has been arrested. The franchise has come out quite strong in my view. And the fact remains that as rural initiatives of the government takes shape, the overall drive towards consumption growth in the rural markets will pick up, and that also drives in a way our preference towards Colgate.
All right. Gautam, pleasure speaking with you. Thank you very much for waiting by with us today morning. Well, the early rates are coming in, but